Okay, good morning. Can you hear me? All right, very good. As usual, we'll start today's lesson. Today will be on tutorial 5 on the topic of tutorial 5 here, advanced CAPM, analyzing project risk and beta determination. So basically, it's something that you did before in your other finance unit, which is the WACC, we call it, the weighted average cost of capital. And that's basically what we're going to do today. All right, and I realized that there's a number of questions regarding your assignment. So what I can tell you, I don't know much about the assignment, but what I can share with you is your calculation. These are the few things that are being told by your module leader. Your calculation is considered as word count also. Okay, it's included in the word count. All right, whether the theory that you're using, whether NPV is positive, whether you can get your BCR is below 1, is all these things relevant or not? You need to find out and you need to tell us. Okay, this is part of your assignment. All right, you need to be sure on what is the final answers or the final explanation to it. All right, just the only thing I can let you guys know is regarding the word count. The calculation is including in the word count, and also you need to do explanation, of course. That's it. Okay, so good luck with your assignment. Hopefully that clear things up. And now let's move on to today's tutorial then. Today's tutorial is on the first question here. I don't know how to pronounce this name. The Dibija. I don't know. All right, the corporation common stock has a beta of 1.21. So just write down your beta. Beta 1.21. If the risk-free rate is 3.5%, interest rate is 3.5%, 0.035. Okay, and expected return on the market is 11%. What is the cost of equity capital? So cost of equity, okay, this is the expected return on the market is 11%. Okay, return on market is 11%. And they are telling you to find the cost of equity. Okay, cost of equity. All right, this is the one that you don't find. All right, so as you all know, you did in your previous other unit, okay, cost of equity could be calculated with the CAPM model, capital asset pricing model. Okay, so in CAPM, your cost of equity, it's equals to cost of equity, this one is equals to risk-free, okay, plus beta, all right, return on market minus risk-free. Okay, this is the formula. So RM, return on market minus risk-free, sometimes also considered as market risk premium. So if this is given, then you don't need to do the calculation. You already know this is market risk premium. So this is the formula that you use to count your cost of equity. Okay, so based on the information given to you, to count the cost of equity, you already got your risk-free. Your risk-free is 3.5%. Beta is given to you 1.21. Market risk, okay, your return on market is 11%. Minus your risk-free 0.035 again. So this is the figure that you put inside. In the end, you can find the cost of equity 0.1258, or also can be written as 12.58%. So no need to use any financial calculator. Just remember this formula. If you can remember this formula, done. You can already find the cost of equity. Okay, to find cost of equity, you can use CAPM. Simple. Please let me know if you guys are facing difficulty. Okay, I think this is just a recap of what you have done before in other units. Okay, this is for first question. All right. Of course, after accounting cost of equity, question number 2 here, they tell you to calculate the cost of debt. Okay, so let's go through the question number 2 now. So please stop me, whoever cannot follow. Question number 2 here, advancing corporation is trying to determine its cost of debt. Okay, cost of debt is written as RD. The firm has a debt issue outstanding with 17 years to maturity. Okay, time is 17 years to maturity. That is quoted at 95% of face value. Okay, so FV quoted at face value of 95%. No, this is not FV, this is PV. Okay, PV at 95% of 1000 means 950. The issues make semi-annual payment and has a coupon rate of 8% annually. Okay, semi-annually payment on coupon. So 8%, all right, 8% divided by 2 multiplied by 1000. So it's 4% of 1000. So this is $40 for the payment. What is advance pre-tax cost of debt? If the tax rate is 35%, what is the after tax? So you want to find the before tax and after tax of this. Okay, so you need to find the RD and the RD after tax. This is the two things that you need to find, and this is the information given to you. Okay, so to count cost of debt, very simple. The formula to count cost of debt is basically using the bond formula. Okay, the long method is PV, okay, equals to PMT times with 1 minus 1 plus R power of T divided by R plus FV divided by 1 plus R. Okay, 1 plus R. All right, 1 plus R power of T, of course. You discount it backward. So if you don't want to use this formula, this is the standard classic bond formula to use to count the cost of debt. So to make life easy, okay, or simplified way to write it, although it's not given to you, you can just put it like that. PV equals to PMT multiplied by PVIFA, okay, percentage and time, plus, all right, the FV value multiplied by PVIF, percentage and time. So this is the formula lah. So either one lah. If you're using calculator, basically you're just going to use this. Okay, because you're not given this table in your exams. All right. So very simple. Just plug in the calculator. Okay. Payment is 950. Present value is 950. Payment is at 40. All right, because divided by 2. Not to forget your time. Okay. So here will be. So just erase this off. 1 plus 1 over 1 plus R. Your R is how many percent here? Follow what's the percentage to give you? The R is the one that you don't find. Okay, this is the cost of debt. All right, the R is the one that you don't find. Okay, and then divided by, okay, cannot use this. Cannot use this formula. I'm sorry. All right, it's either this or your financial calculator. Because you're going to find R inside this bond formula, you need to use try and error. Okay, you need to use try and error. So your RE is the R inside this formula or the percentage here. Okay, or the percentage here. So it's best to use financial calculator. If you have a financial calculator, what you need to do is your present value, you put there plus minus 950. Okay, PMT, put in 40. Your time, make sure the time, very important here. It's 17 years, right? But it's semi-annually, so 17 times 2, so it's 34. All right. FV is equals to 1000. Okay, for bond, the face value is always equals to 1000. Cannot run one. Okay, cannot run. So you got your PV, you got your payment, you got your FV, and you got your T already. So you can straight away compute IY. Okay, compute IY. So yeah, this one you must use calculator. No choice. Okay, no choice. Unless you use try and error like this. It's going to take very long time. So if you have your financial calculator, you can compute IY straight away. So your IY given to you is 4.28%. Okay, 4.28% or 0.0428. But keep in mind, this is for semi-annual. Okay, so you want to find for annual. Okay, for annual, your yield to maturity is actually 4.28% multiplied by 2. You get 8.56. All right, 8.56. Okay, this is your cost of debt. Okay, to count your cost of debt after tax, so take this 8.56 multiply by 1 minus 35%. Okay, then you can get your after tax. So your after tax will give you 5.57. This is after tax. This is before tax. Can follow, cannot follow. So a bit confusing just now when I talk about the formula because I've forgotten that this is actually compute R. All right. So when you need to compute R, you use the bond formula. You cannot find R. You need to use trial and error. Try until you can get P equals to 950. So that's going to be very, very troublesome. So if you have a financial calculator, you just need to key in like this, as I shown you. Then you can compute. Make sure to times 2 because this is semi-annually. Okay, semi-annually. So make it back to annual, yield to maturity. So 1 year yield to maturity is 8.56%. After tax is after deducting 0.35. Okay, so the balance is 0.65, which is 5.57%. So far, so good. Are you okay? Having any difficulty so far? Anybody? Okay. Thank you, Brian, for responding. Very good. All right. So now we already know how to calculate cost of equity. We already know how to calculate cost of debt also. So the next question here, question 12, okay, from the question here should be question 12. They call you to find WACC. So basically, after knowing this cost of debt and cost of equity, you can combine both of this. You know how to find WACC. Okay. So let's look at question 3. What are the information given to us? So question 3 here, Titan Mining Corporation has 9.3 million shares. Common stocks, 9.3 million. Okay, and 260,000 semi-annual bond outstanding. Okay, so the next information here, this one, the first one, 9.3 million common stock. This is equity. Okay, equity. The next one is debt already. The debt information here, they tell you 260,000 semi-annual bond. Okay, the payment is 6.8%. So 6.8 divided by 2 is 3.4 multiplied by 1,000. You know, it's 34. Par value 1,000 each. Okay. Par value is 1,000. So par value here is your PV. Sorry, the par value here is your FV. Sorry, it's always 1,000. Par value they give 1,000. The common stocks currently sells $34. Okay, this is the common stocks. The price is $34 and has a beta of 1.2. Beta 1.2. Oops. Or this one is for the equity, beta 1.2. And the bonds have 20 years to maturity. This debt maturity is 20 years since it's semi-annually times 2, so it's 40. And sell for 104% of par. So PV is 104 of 1,000. So it's 1040. Present value is 1040. The market risk premium is 7% T-bills. Again, market risk premium. So the RM minus RF is 7%. T-bills Okay, T-bills is risk-free. Treasury bill is risk-free, 0.035. And the tax rate is 35%. Okay, so that one no need to write lah. So these are the information given to you. So 12A, what is the firm market value capital structure? So to count market value capital structure, they just want you to find the total value of the firm. How much it consists of. So 12A, very simple. Okay, your equity, how much? Equity is 9.3 million stocks multiplied by $34 each. So this will give you what number? Okay, this will give you what number? So this is 316,200,000. The next is counting the debt. Okay, $260,000 multiplied by your present value, 1040. Okay, so your bonds here value at 270,400,000. 270,400,000. So total is up together. This is the total market value. 600,000. 685. Okay. This is the total market value. Although the question never tell you, but you know we need to find WACC. So to find WACC, okay, you need to find the weightage. All right, need to find the weightage of equity. Okay. Weightage of equity and weightage of debt. So to count weightage is very simple. So your equity is 316,200,000 divided by the total here 586,600,000. So find how many percentage of it is equity. For debt, 270,400 divided by 586,600. So find what is the weightage. So this one for the equity it should be 0.539. That means 53.9% of the capital structure consists of equity, and of course the balance is debt. 46.1% is debt. So you already got the weightage. Okay, you already have the market value, no need to carry. So market value for you to count the weightage only. Once you got the weightage, then done already. So part B, if Titans is evaluating a new investment project that has the same risk as the firm's typical project, what rate should the firm use to discount the project's cash flow? What are the rates? All right. So what is the rates that you need to know? So basically, you need to calculate the WACC. Okay, to find the WACC. So 12B, they want you to find WACC. Before you find WACC, you need to find your cost of equity. Okay, to find cost of equity first. So cost of equity, simple lah. Use a CAPM model. Okay, risk-free plus beta RM minus RF. Okay, so risk-free rate just now, I already tell you is 0.035. Beta 1.2. They tell you the market risk premium straight away, which is 7%. So it's 0.07. So this already gives you the cost of equity easily. So you can get 0.1190 or 11.9%. Second part, already got cost of equity. You count cost of debt. Okay, to count cost of debt. So to count cost of debt, basically use the bond formula. PV equals to PMT multiplied by PVIFA percentage. This is the one that we're going to find. And the N plus FV PVIF percentage and N. So this one, the PV, present value just now, we already know, 1040. Okay, the payment, we calculated also, 6.8 divided by 2 times 1000, 34. PVIFA, percentage unknown. Okay, period is 20 times 2, 40. Plus FV is 1000, PVIF, unknown, 40. Okay, so of course try and error is going to be difficult, so use your financial calculator. Okay, use a financial calculator. PV negative 1040, PMT 34, FV 1000, N equals to 40, compute IY. Okay, compute IY. Again, this will give you 3.22. But this is for semi-annual. All right. Your cost of debt, also known as your YTM, should be for a year. So times 2. So 6.44. Or 0.0644. This is your YTM. Okay, this is your YTM. Of course, you need to find the after tax lah. Okay, because in the WACC formula is including after tax. Debt must be deducted by tax. So, see 6.44 times with 1 minus 0.35. You get 4.19 or 0.0419. So now, to count your WACC, you got all your information already. So the formula for WACC is what? I hope you guys remember. Weightage of equity multiplied by cost of equity plus weightage of debt multiplied by cost of debt. Okay, 1 minus T. Or cost of debt after tax. Or DAT. So the weightage, just take back the weightage that we got just now for equity is 0.539. The cost of equity here, just now we calculated back how much we get. Oops. Cost of equity 11.9. Okay. So 0.119 plus weightage of debt is 0.461 multiplied by the after tax 0.0419. Total this up together, you can get 0.0834 or 8.34% as your WACC. Okay, any difficulty so far? Anyone having any issues? No, So it's quite simple. This is something that you already did before in your intro to finance and in your other financial unit. So this is a repetitive unit. So it's a repetitive section on WACC. All right. So if you have no issues, we'll move on to question number 16. Question number 16 here, they want you to find the NPV with the WACC. So what does it mean here? So Wacc Incorporation, all the name very funny. Wacc Incorporation. Wacc Incorporation is considering a project that will result in initial after-tax cash saving of 3.5 million at the end of the first year. Okay, so they're telling you here initial after-tax cash saving of 3.5 million at the end of the first year. So this is value worth $3.5 million. And this saving will grow at the rate of 4% per year indefinitely. Growth rate 4%. 0.04 per year. The firm has a target debt equity ratio. Okay. Debt to equity ratio of 0.55. All right. Debt to equity ratio is 0.55. So you need to know your debt is 0.55, your equity is 1. Because 0.55 divided by 1 is equals to 0.55. Okay, debt to equity ratio. All right. A cost of equity. Cost of equity, RE, 13%. And after tax cost of debt, RDAT, of 5.5%. The cost-saving proposal is somewhat riskier than the usual project the firm undertake. Management uses the subjective approach of plus 2% to the cost of such risky project. Under what circumstances should Wacc take on the project? So they're telling you it's riskier, okay? So it's plus 2% on your cost. Okay? That means plus 2% on your weighted average cost of capital. All right. So given all of this information, they want you to find number 1, WACC. And then knowing WACC, you need to count the weightage of equity multiplied by the cost of equity plus weightage of debt multiplied by the cost of debt after tax. So weightage of equity is how much? So equity is 1. Again, equity is 1. Total market value is 1 plus 0.55. So 1 over 1.55 multiplied by your 0.13. Plus weightage of debt. Debt is 0.55 only. 0.55 out of 1.55 multiplied by 0.055. This will give you your weighted average cost of capital. 0.1034 or 10.34%. After having this information, they are telling you, okay, this is supposedly your capital. All right, but this is riskier. So you need to plus 2% on your cost. So the final percentage, your cost of capital should be 12.34. 12.34 is your new adjusted one. Okay, your new adjusted cost of capital. All right, so the next thing, under what circumstances should Wacc take on the project? That means NPV must be more than 0. Okay, NPV must be more than 0. All right. So basically, NPV more than 0, you need to count the net present value. So you need to count the net present value. All right. So net present value, how do you want to count? Okay. So in this sense, all right, because you're assuming everything is gonna be constant, okay, and it's supposed to be perpetuity, all right. So to calculate your NPV, how do you count? Your NPV, you can count with the dividend growth model. Okay, dividend growth model, which is NPV will be equals to the present value over R minus G. The present value here is 3.5 million. The R here is this cost of capital. Okay, 0.1234 minus growth. Just now they tell you a growth rate of 4% per year indefinitely. How do you know this is a constant growth rate? Because it's 4% per year indefinitely. Okay, so this will give you NPV. So 3.5 million divided by 0.1234 minus 0.04. You want to know what is the present value of the whole cash flow. So what is the net present value? So you get 41,972,921. So this gives you a positive figure. Okay, therefore you cannot accept this project. Okay, so this is the present value. No, this is a positive figure. This is a present value, but it does not mean what? Means this project could be undertaken if the cost is less than this. Okay, therefore accept project if cost is less than this amount. So basically calculated an exact figure here, which is 41. The return is 41,972,971. Okay, so if the cost is less than this, then you can accept the project. Okay, so this telling you this project gonna give you a 41,972,921 return. So for you, for the logic behind it, for you to accept this project, if as long as the project costs less than this, you will do it. Make sense or not? Can or not? So the complicated part about this question is only here. When they tell you it's riskier, so it's 2% extra. So it becomes 12.34. Okay. And then how do you know the question? How do you want to calculate this? Because they tell you it's 4% per year indefinitely. All right. Growth rate of 4% indefinitely. So you use the dividend growth model. All right. Dividend growth model. Then you can get this figure. Okay. Can? Can, cannot? Why it should be the cost part? Which one? This cost. All right, so very simple. You see, this question call you to find first you need to find the WACC, which is the cost of this project. This project actually only costs you 10.34%. Okay, but now the question is telling you the cost saving proposal is somewhat riskier because now this one is having a cost saving. The cost saving of 3.5 million. So this is not PV to correct, and it's actually D1. Okay. The dividend growth model formula, D1 divided by R minus G. Okay. So this is your dividend. This is basically a cost saving. Every year cash flow, you'll get 3.5 million constantly, indefinitely. And the growth rate is 4%. Okay. So, but initially, the cost of this whole project is only 10.34%. But because now, there's a constant cost saving, there's an increase of 2%. You see, use the subjective approach of 2 plus 2% to the cost of such risky project. So in the end, your WACC is 12.34%. All right. So this is your new rate. So you want to count if every year you're going to receive 3.5 million, okay, indefinitely, forever, never ending. What is the present value today? So the present value is actually 41,972,921. So if you want to be profitable in this project, you will take over this project if the cost is less than this amount. So this is the break-even point. Can Fabian understand? Sure. So easy to understand. Let's draw in a timeline. So this question is basically something you guys did before. Okay, is the annuity. Okay, this is the dividend growth model. So that means you're going to receive payment non-stop forever, 3.5 million on cost saving all the way. Okay. All right. This is time 0, 1, 2, 3 until infinity, 3.5 million. So you want to count the present value now. Okay. The present value now worth how much? So the present value here now is actually this figure. So for you to invest in this project, okay, and then to get earning from it, you definitely need to cost less than this amount. If it's higher than this amount, you don't make money. If it's the same amount, you only break even. What's the point of doing it? So it must be cost less than this, then only you can make the profit. The difference is the profit. So I think this makes things easier to understand in a timeline. Okay. All right. So if all okay, I will move on to the question number 17. Okay, hopefully. Any questions so far? No, no one asked me anything, so I assume all okay. So okay. Question 17, a very, very long one. All right, a full question here. Information given you very little. Okay, so let's see what is this about. So the Saunders Investment Bank has the following financing outstanding. Calculate the WACC for the company. Okay, so calculate the WACC for the company. So find WACC. So let's see debt itself. Debt. Got two things here. Debt one, 60,000 bonds with a coupon rate. 60,000 bond with a coupon rate of 6% and a current price quote of 109.5 of par. The bond of 20 years. Okay, this 6% never tell you is it annually or semi-annually. We also don't know. All right, annually or semi-annually also we don't know yet. So let's see carefully what is it about. Oh, okay. All right, so our current bond at 109, the bond have 20 years to maturity, then 230,000 zero coupon bond with a price quoted of 17.5 of par and 30 years to maturity. So coupon payment for both semi-annually lah. So semi-annually. So you see, the first one is 60,000 bond of it, all right, and the coupon rate is 6%. So 6% divided by 2 multiplied by 1,000. This is a PMT. So this is 30 bucks. Okay, PMT. $30. And the current price quote of 109.5 of par, the bonds of 20 years to maturity. So N equals to 20 times 2 equals 40. Okay, the present value quote is 109.5 times 1,000. So it's 1095. Face value is still 1,000. Okay, the next bond, bond number 2, how many they got? 230,000. Zero coupon bond with a price quote of 17.5 of par. 17.5 of par. And 30 years to maturity. So this one, PMT equals 0 lah, because no coupon. And it's still 40. Present value is 17.5 only. So means is 0.175 of 1,000. So this is at $175. Okay, $175. And 30 years maturity. No more 40. Sorry, this is my mistake. $30 times 2 equals to 60. 60 years maturity. And that's it. This is for your debt information. FE is still 1,000. Same. Okay. This is for debt. Next is preferred stock. Preferred stock is different from equity. Preferred stock is different from equity. So 150,000 shares. 4% preferred stock with a current price. Okay, 4%. 150,000. R is equals to 0.04. And a current price of 79. And par value of 100. Okay. Moving on to last one is equity, common stock. So equity information here, 2.6 million shares. Oh, a lot. Current price is 65. And the beta is 1.15. The corporate tax rate is 40. Market risk premium, okay. Market risk premium is 7% again. Risk fee is 4%. So these are the information given to you. So first of all, find WACC, you need to count the weightage first. Find the value of each and every one of these. Okay? Find the value of each and every one of these. So first, you need to find the value of each and every one of it. So first, you want to find the value of the first debt first. So they're debt 1, debt 2. All right? Debt 1, debt 2. Okay? Debt 1. Debt 1 is back to the 60,000 bond. 60,000 bond. Okay? Multiplied by 1095 value. You get 65,700,000. Debt 2. Debt 2 is $230,000 zero coupon. And it's only 175 each one. So this will give you 40,250,000 value. Preferred stock. Preferred stock 150,000. Each one value at $79. So 11,850,000. Lastly, equity. Equity very large, 2.6 million. And each one value at 65. So give you $169 million. Total market value and everything together. Okay, and everything together. You get 286,800,000. After having the total market value, you can find the weightage of each and every one of it. Okay, you need to find the weightage of each and every one of it. So WD1 is equals to 64 divided by 286,800. Okay, this is the first step. WD1. All right. So calculate the figure here. Then calculate WD2. 40,250,000 divided by 286,800. So calculate for me. I don't have the figure yet on. So please calculate for me. Then preferred stock. Weightage of preferred stock. 11,850,000 divided by 286,800. And lastly is the weightage of your equity. 168. Sorry, 168. Correct, right? Sorry, 169. 169 million. 286,800. Okay. So calculate the weightage first. Get the weightage for every one of these, then we'll count the cost. So don't know how many of you calculate. 700,000 divided by 286,800,000. Okay, the first one will give you 0.0229. Okay, 0.229. 229. Hopefully I'm not wrong. Then the next one is 40,280,000 divided by 286,800,000. 0.14. Okay, 0.14. The next one is 11,850,000 divided by 286,800,000. Oh, very small, 0.041. Okay, 0.041. And the last one is 169 million divided by 268,800. 0.629. 0.629. Okay, so 0.629. These are the weightage here. So this is not accurate lah. So supposed to be 4 decimal point, but I only put here 3. So this is not so accurate. So it's 0.629 because it's given here from my calculator here. Not so accurate. And we can make it accurate. 6287. This one should be 6287. The previous one is 0.413. 413,404. 413,404. 2291. Okay. So now supposed to be much more accurate. I don't know. Let's see. So yes, 4 decimal point done. This is the weightage. After having the weightage, we are not done. We're going to do WACC. So a lot of work. This is only the weightage here. So now, first, you need to find the cost of your equity, cost of your debt, cost of your preferred stock. Okay. Cost of equity is the easiest. Use CAPM model again. All right. The risk-free rate is 0.04. So the weight of equity should be. Really? So my one got wrong. 169 million divided by 286,800. Oh, 0.5893. 5893. Yep. 5893. Thank you. Is it? That's all? The rest all correct? The rest correct, huh? Yeah, I checked already. Yep, I typed wrongly just now for the one I put 268 instead of 286. Okay, I guess that's right. All right, so move on to the next one. We need to count cost of equity first. Cost of equity, the risk-free rate is 4%. Beta given to you 1.15. And the market risk premium is given to you 7%. So this will give you your cost of equity. Okay, so cost of equity is 0.1205. Next, which is the cost of debt one. Okay, cost of debt one. RD1. So RD1, use your financial calculator. RD1, financial calculator, let's show you. Present value, negative 1095. Okay. Your payment, 30. N is 40. FV, 1000. Compute IY. So your debt for the first one, the first debt, it should be given you 2.61%. Again, this is for only semi-annually. All right. So to get the YTM times 2, which is 5.22. Okay, 5.22%. So 5.22%, you want to find the after-tax rate. 5.22 multiplied by 1 minus 0.4. The tax rate is 40%, right, for this question. So 1 minus 4. Then you can get 3.14%. This is your cost of debt 1. Okay, cost of debt 1. So don't forget, there's a second one. Okay, the second one, there's no coupon. Okay, there's no coupon. All right, so basically there's no payment. So straight away, present value negative 175. All right, PMT you put 0 because no payment, no coupon payment, and is 60 years. FV 1000. Compute IY, you'll be 2.95%. So the YTM is 2.95 times 2. Okay, so should be getting 5.9. So the RDAT2 is 5.9. 1 minus 0.4. So it should be 3.54. So the weightage for that one is just now there. This is the cost of that one, and this is cost of that two. So remember these two is important for your weighted average calculation here. So we got our equity, we got that one, that two, and now the last one is your preferred stock. Okay, to count your preferred stock. All right, so that of preferred stock is very easy. Preferred stock is actually equals to dividend divided by price at time 0. So the question tell you the preferred stock, how many dividend they tell you? Let me read back. The preferred stock give you a 4%, shares of 4% preferred stock. So 4% of $100 is $4. Okay, $4, 4% of 100, the par value, 4% of the par value is $4. Okay, and then divided by the current price. Present price at time 0 means the current price of 79. So this will give you your cost of preferred stock, 0.0506, a very small figure. So now having all the figure, you can do WACC equals to weightage D, the first weightage. All right, look back, your weightage just now. Where's my weightage? 0.2291, 0.2291 multiplied by the first debt, 0.0314 plus 0.1404 0.0354 plus preferred stock just now, very small amount. What is that? 0.0413, 0.0413 multiplied by 0.0506, and lastly 0.5892 multiplied by the equity. Equity is where? 1205. Okay, so this will give you your weighted average of cost capital. Okay, weighted average cost of capital 0.0852 or 8.52% for the whole thing. It's a very lengthy process. All right, it's a very long process, but you need to do one by one slowly to get the information, and then you can calculate it and you can get the final answer. Okay. All right. Hopes that give you an idea. Can, huh? Are you okay? Cannot follow? No, there's a lot of information, very lengthy. So can follow or cannot follow? Hello, are you all there? Can follow. Very good. All right, very well done. Okay. All right, so we move on. The next question here, question number 18, is the repetitive structure as this one. So you try this at home and see whether can you get the answer or not. Okay, so this is part of your homework. As you realize, students don't really try doing the questions at home for discussion purposes. So your module leader suggested we should have let you try one of the questions if it's a similar one. So I won't do this with you on 18, but when she upload the formula, you will be able to see the solution and you can compare. So if you couldn't get the answer, then you can come and ask me in next week class. So I'll skip the question number 18 and we'll move on to question number 14. Okay, question 14 here. Question 14, calculating flotation cost. So let me adjust this back. So what is this flotation cost? Let's see. Suppose your company needs 20 million to build an assembly line. Okay, a cost of 20 million to build an assembly line. Your target debt equity ratios, debt to equity ratios is 0.75. The flotation cost for the new equity is 7%. Okay, flotation cost is 7%. But the flotation cost for the debt is only 3%. All right. So FE, flotation cost for equity is 7%. Flotation cost for debt is only 3%. Your boss has decided to fund the project by borrowing money because the flotation costs are lower and the needed funds are relatively small. Okay, these are the information given to you from the question. They already tell you your boss has decided to fund the project by borrowing money because the flotation costs are lower and the needed funds are relatively small. All right. So what do you think is the rationale behind borrowing the entire amount? So your boss just make a decision like that and you think is not sufficient. So question A is a theory question here. What do you think about the rationale behind borrowing the entire amount? So it's not just looking at the cost here. Just looking here, 3%, he think is low. So he shouldn't do that. All right, the answer to A is he should find out the WACC. Okay, the WACC of flotation cost, weighted average flotation cost. So WACC of flotation cost. All right. So what is your company's weighted average flotation cost, assuming all equity is raised externally? So assuming that your equity are coming from outside. So this one is very simple. To count flotation cost actually is same like WACC. So instead of taking the cost, this flotation will replacing the cost. Okay. So now they tell you, assuming all equity is raised externally, that means get from outside. Okay. And then you remember your debt to equity is 0.75 to 1. So debt is 0.75, equity is equals to 1. So to count your flotation cost, okay, for your debt is 75, right? So 0.75 divided by total of the whole thing is 1.75 multiplied by debt 0.03 plus equity is 1 out of 1.75 times 0.07. So this will give you your cost weighted average of flotation cost. 0.0529 or 5.29%. Okay. So what is the true cost of building the new assembly line after taking flotation cost into account? All right. So if you take the combination of these both based on the debt to equity ratio, okay, this is the weighted average flotation cost, 5.29%. So let's say what is the true cost of the assembly line after taking the flotation cost into account? All right. Flotation cost means here the cost of fluctuating. Okay, the fluctuation cost. So here, you want to calculate the $20 million will fluctuate how much? How much is the amount in the end of the day? So very simple. To count that, you basically want to count the amount, the actual amount, all right, the true cost, the actual amount, which is $20 million divided by 1 minus 0.0529. Okay, so the true cost, the actual cost after incorporating the fluctuation percentage, it's 21,116,139. So this is basically what you mean by flotation cost. Okay, the fluctuation of the initial costing. Very simple. All right. Okay. So to make it clearer, we will continue with the next question. Question 18, also talking about calculating flotation cost. So let's see what's the difference here. So the next question here, Southern Alliance Company need to raise 55 million. So the cost is $55 million. All right. And then to start this new project, they will raise money by selling new bonds. So bonds here is debt. The company will generate no internal equity for foreseeable future. The company target capital structure of 65% common stock, 5% preferred stock, and 30% debt. All right, so common stock 0.65, preferred stock 0.05, and debt is 0.3. So total up is 1. Okay, so flotation cost for issuing new common stock are 8%. Okay, common stock here, the flotation cost of equity 0.08. Preferred stock is 5%, 0.05. And flotation for debt is 3%, 0.03. What is the true initial cost figure Southern should use in evaluation the project? So first, you need to find the flotation cost, the weighted average flotation cost. Okay, so it's basically F lah. F is equals to equity 0.65 multiplied by the cost of flotation plus preferred stock. This one easier because they already give you the percentage. 0.05 plus 0.3, 0.03. So the flotation that you cost, the flotation cost that you get is 0.064 or 6.4%. They tell you 55 million, you need to find out what is the flotation, what is the true cost. So basically the amount of $55 million divided by 1 minus flotation cost, you get 58,729,311. This is the true value. This is the amount that you will be paying. I think this flotation cost is actually quite easy compared to the WACC. WACC, you need to calculate one by one the debt. This is more given. All right. So far, do I have any students facing any difficulty following or not? Are you guys okay? So please try question number 18 at your own pace. Try to see whether can you solve it or not. It's very important. You must learn how to do it yourself without referring to the answer first. If you refer to the answer, that is not fair, okay? Because in the exam, you cannot refer anything. It's basically based on what is the final answer you're going to give. That's the submission answer. Okay, so any issues so far? Any questions from your side?